Today, I had the opportunity to speak with Ahan Vashi, a seasoned investor with a professional background in equity research, private equity, and software engineering. He now spends his days analyzing companies for his own private investment group called TQI. He shares a lot of his findings on Seeking Alpha, where I noticed he had a strong buy rating on SoFi Technologies whenever it was at $9.16 a share. That was written about a week ago. Today, the stock is at $7.88, where we saw a pullback of about 14% in just that little period of time. I knew I wanted to talk to Ahan to get his perspective of what was happening in the stock price, as well as his price targets and how long he plans on being a shareholder. But that's enough of a background. Please enjoy the conversation. Ahan, thank you so much for being with me, my friend. I really do appreciate it.
Hi, Tanner. Thanks for having me on.
So, you had written an article on Seeking Alpha saying that the profits are just getting started for
hmm
SoFi Technologies.
Yeah, I mean, my article was the profit party is just getting started,
Yeah.
and I now have like a new price target of $21 for SoFi.
$21. So you had wrote this
hmm
back at $9.16. The stock
hmm
sits at $7.88 at the time that we're chatting
hmm
right now. Are you still as confident as before? And how are you looking to invest in this? Are you seeing this as a long-term hold, or what do you believe?
Yeah, so I mean, I started tracking SoFi, or I took my first position in SoFi at around $5. That was back in November of 2022. Since then, or October of 2022, I would say, I started buying then, and then kept adding a little bit. My average is around 6.5 right now.
Yeah.
The thing is, like, SoFi for me is a very long-term investment. It's a unique, offering, or a unique company
Mhm.
within an ailing sector. So, as you may know, financial sector is under a lot of pressure, um, and the pressure is coming from all different risks that are related to credit, and of course, a recession is being talked about. Now we don't know if or when it would come,
Right.
but I'm in the camp of that there might be a recession, which is what SoFi guided for in 2024, and yet it's a company that's set to grow at 15 to 20%, 23%. That's
Yeah.
their implied growth rate. So it's an incredible growth story. Of course, we'll talk more about the ecosystem, what they have built, and how they are doing. But for me, SoFi is a very, very long-term investment, and I'm like, I have a big position there.
So that was something that really caught my eye in your article. So SoFi
Mhm.
right now is presuming about a decrease in GDP 2.5%, unemployment up 5%. And you wrote, and I'm just going to quote you here: since I agree with SoFi's outlook for an economic slowdown, a hard
Mhm.
landing, I am pleased with management's proactive risk management in their lending operations,
Mhm.
despite the cost of being at lower growth in 2024. What are your assumptions for 2024 from a
Mhm.
macro perspective?
Yeah, so at my investing group, the Fundamental Investor, we have this thesis wherein either the economy has to the economy is probably headed for a slowdown
Mhm.
after what has been like exiting 15 years of artificially low interest rate environment. I don't think that the process of getting out of it or having a real cost of capital will be um, a pain-free exit. So now that we have had interest rates at around 5% for a year and a half, I think the market is starting to see the effects of that cost of capital on the real economy.
Yeah.
Um, while the job numbers are still good enough, the trend, like the revisions that have been coming for the last 12 months, have all been negative in the
Right.
sense that they give out a very good job number and then they revise it lower. So last week we had an amazing print in terms of having like 35,000 jobs added in the real economy. But if you look underneath, all the jobs are coming from either healthcare or government. Those jobs are not your everyday jobs. And then the jobs that are being actually lost are like white collar jobs. So we have started losing white collar jobs, and blue collar jobs are very, very much available still. But that is what I'm seeing on an overall effect. What I see is a consumption slowdown coming, and then once that hits, I think SoFi is on the right track, wherein they are seeing this kind of a slower economic background. It may not be anything like what we saw in 2007-08, but it could be a little bit more painful. Of course, the Fed is probably done with the rate hiking cycle. They are now looking at when to cut. Maybe that decision comes in March or maybe the summer. But the thing is, the damage could have already been put in, because all these monetary policies, they will take time to actually show their impact in the economy. And as long as data is good, the Fed may not be able to pivot.
Right, right.
Something which SoFi's outlook does factor in, because they have seen 4 rate cuts for this year, which is
Yeah.
higher than where the Fed is right now.
Hmm.
But giving out or laying out their outlook for this year very conservatively is the right way to go, and I think that it aligns with how we are thinking about the world right now. Um, and I think it is the right way to approach it. Maybe there will be no recession and we will go scot free, have no landing, and then things will be hunky dory. But then that's a positive surprise for SoFi
So
and for us.
what did you think about recent jobs report? Because the way that I'm seeing it for SoFi is that we can look one of two ways, and
Mhm,
one that could potentially help with default rates. I know that SoFi's
mhm,
loan book is still pretty small comparatively to the general jobs numbers that we're seeing, but
mhm,
still expecting potentially lower unemployment rates in the latest job report than what was actually expected. But also that might keep rates higher. Where does
mhm,
SoFi want to go if we want to get out of that conservative assumption? Like because if it is being extremely conservative, are rate
mhm,
cuts good for SoFi? Because I've seen some street reports say that that could potentially, further lower their coupon rates and have
mhm.
repayment come back too quickly. What are your thoughts?
Yeah, so I think we need to think about how SoFi's customer base is. So if you look at what SoFi has done over the years, like they built a loan book which is pristine in the sense that they
Yeah.
have very high FICO score customers, which means and they are high earners. So where is the actual job losses happening right now? It's amongst that white collar segment,
Mm,
right? So SoFi being like knowing their customers so well, they know that maybe they are seeing higher delinquencies within their own customer base, which is probably why they are so cautious about 2024,
sure.
right? Now, what happens is if rates start coming down, which is the Fed lowering interest rates, Anthony Noto has already committed to maintaining the coupons for their depositors. So they said that we will hang on, like we will keep providing a higher APY for our customers, for
Hmm.
our depositors, for a longer amount of time, even if the Fed cuts.
Right.
So in terms of where I see NII margins, which is the net interest income margins, I think they will be headed a little lower. So I think that will impact SoFi's profitability a little bit. But of course, they are already pricing it in. Like I mean, in their forecast, they have already done it. Like they are looking at 5% plus unemployment rate, which seems like very difficult to happen right now. But they are already pricing it in, and then um, so we could be set up for a series of surprises, raises and beats like they have done over the last couple of years. um, and I think that they have put out a very good guidance which is very conservative. So I think they're doing it the right way, they're managing the business the right way. The biggest risk probably for SoFi is its loan book. As you know, that majority of their loan book is unsecured personal loans,
Right.
which is probably why the market is also pricing SoFi as a typical bank and not giving it any credence for its growth, because they believe that maybe the personal lending loan book is not as good as SoFi claims that it is.
So this has been a topic of discussion, at least in the circles that I'm talking with.
Mhm,
Is although we did see a pretty good sizable sale this quarter,
mhm. Yes.
1.2 billion, I think
Mhm. Yes.
875 million was personal loans.
Mhm.
I I'm of the personal belief that that was due to um, Q4 actually having a much higher rate chance of cutting in March than we do today, right? Do you think that we're going to see a slowdown in Q1 for loan sales?
No, I think loan sales are gonna pick up from here.
Okay.
So from what I understood from the management's commentary was that they are going to be de-risking the business a little bit as they go into the year, and you know as rates come down, or as coupons in the market or the cash cost of capital goes down, the loan value, or the personal loan book value will actually go up as long as defaults don't spike.
Sure.
So,
Sure.
considering that, I believe that they have a very good customer base,
Mhm.
and they still don't have delinquency rates that are at pre-pandemic levels. So they haven't still reached those levels. So I believe that those loan books are worth more than they are currently marked at. So if rates come down, I believe that they'll be able to sell more of these loans into the market. And as that happens, they'll have more lending capacity coming open, but they may not use it. Like they may still not try to grow the lending business, or like the lending revenues
Right.
um, at what the market was actually expecting going into the year before their guidance for 2024 came out.
So the lending capacity for 2024 is looking amazing. I think they even management commentary said somewhere along the lines of 18 to 20
Mhm.
billion. They
That's
might not
correct.
even use all that.
Mhm.
Um, especially if they're trying to keep capital ratios high because it was getting a little bit worrisome
Mhm.
down in the mid fifth or mid 14%. Now I
Yes.
actually think it rose this quarter, which was a great
Mhm.
sight to see. But um, I guess my question would be: are you in the camp of we don't even need a March cut in order for there to be great loan sales because rates are not looking to continue higher? Or
Yeah, I mean the if you look at the ABS markets, right? They have
sure,
started opening up ever since like the Fed went on a pause, essentially because they didn't commit to a pause, but rates stopped going up, and the long duration treasuries have started coming down, which means the bond market sees stability in terms of interest rate decisions. So now that the Fed has officially said that we are at the peak of the rate hiking cycle,
yeah,
this means that all the financial institutions can be more committed to what they are doing in terms of buying more loans, and they know that there won't be a lot of interest rate fluctuation on the wrong side of things.
sure.
So if rates come down, their asset values go up, so they are fine owning those kind of loans. um,
Do you think that banks will return to buying things like unsecured personal loans if, um, for example, they might still be running into hard times with rates being so high and potentially having more mature loan books than SoFi does?
yeah, I think probably banks will sit this round out.
Mm,
They are having like the same problems that they had last year, like in back in March of
sure.
2022. The actual problems that banks have is that they cannot essentially meet what other digital banks are doing right now in terms of offering like 4% plus interest rates. They simply can't,
Got you.
because if they do that, their profit margins will get absolutely obliterated, and they might even sink into losses if some of their loan books don't perform. So they are in a very difficult situation. But where I see money coming in is alternative asset managers.
Yeah.
There's
Yeah.
a lot of dry powder sitting out there, and they are looking to go into credit and equities. So the money, like if you look at these unsecured personal loans, while they are construed to be the most dangerous part of the consumer lending arena, but if you look at it, like if SoFi has a good high quality credit, then people will be looking to buy those loans, which we are seeing right now, right? SoFi is able to sell at 105 to 106% of their fair value markup. So
Right.
they are able
Right.
to do that. And it shows that this loan book is being liked by people who are buying it.
So as time goes on and they normalize losses to, I think on an annual basis, the 7 to 8% life alone losses is somewhere
Mhm.
between, I think Anthony said, 4.8 to 5%. Do you think
Right.
that we can still capture that 105 to 106% uh, sale loans?
I think it could be a little lower than that.
Sure.
Somewhere around 3 to 4% markup is where I have seen a lot of other such books being sold. So I think once that delinquency rates are pretty close to normalized levels, I think
Yeah.
it can come a little lower, but the clearance rate will be higher. So I think once interest rate environment is stabilized, more money will go into buying these assets up.
Sure. Okay. Yeah. Fair enough. And then my last question was, and oh, it just escaped me. We haven't seen the 10K yet, so we're
Mhm,
not going to see what SoFi's average coupon rate, what they've done with their loans. My
mhm.
assumption is that it'll continue to climb up. Do you think that that will also increase their, I guess, the fair value of their loans, considering although default rates are potentially coming up, that we might be matching that with coupon rates as well?
Yes, I think so. So if they are seeing in their data that delinquency rates are rising, they are going to price their loans a little higher, which means higher coupon rates. And since I believe that their cost of capital is not going to rise from here for SoFi, it'll
Okay.
probably be headed lower as rates go down. I think the APY that SoFi has to pay to its depositors will also come down. But
Sure.
of course, at a marginal level, I believe that SoFi will be able to hold their NIIs as long as there is not a big crisis out there. So,
What do you think about sequentially? Because they said that they've reduced warehouse facilities.
mhm,
They said 700 million. I'm going to assume that was year over year because I was. They said they had warehouse facilities that were deployed was 3.2 billion, but that was very similar to what we saw in Q3 as well. So, do you think that there will
right,
be
yes,
a
I
shift in
think it
cost of
is.
capital?
I think it is year over year, and they have it like for several quarters. I think they have been trying to you know utilize the capital that is the lowest cost of capital to them.
Hmm.
So I think it makes complete sense. The warehousing, I think more of it they were using for student loans.
Sure.
Um, but then I understand that they have guided that student loans will not grow as much as I believed it would grow when they came out of the student loan moratorium.
Yeah. Why
So
is that? Why do you think that is?
yeah, I think there's not a lot of demand for refinancing at this point. The rates are pretty high. If you look at like maybe people might have taken out student loans at what current the cost of capital is, like around
Right.
5%. So maybe students like the student loans that are outstanding or that need to be refinanced are already probably at 5-6%, and they don't actually need a refinancing.
Right.
Maybe
Right.
some of them will, like the people who are not able to afford their monthly payments, they will
Extending
go
the
out and do it.
terms.
Yes, they
Yeah.
will try to extend the terms, but then not a lot of people are doing it right now. And I don't think SoFi is crazy about pushing those refinancing right now, like probably in this environment. Maybe as the year goes on, I think they will start pushing if they see that the clouds are clear, the economy is good, it's all pulling up all right, and their initial forecast for a recession is not coming to fruition. So, um,
So this is not a big question, but it's something that I've been thinking about a lot, and I just want your take on it because I'm really enjoying this. So, um, as rates start to get cut, I think there will be more utilization of home loans and student loans rather than the personal
mhm,
loans. What do you think how the personal loans will do if there's
mhm.
still a great amount of debt consolidation to be done through credit cards? Do you think that that product line will get wiped out or still see great originations?
No, I think it'll continue to be a big part of SoFi's business. We have like more than $1 trillion in credit card debt,
Yeah.
and that debt is probably at like average interest coupon is around 21-22%. I'm not sure about the exact number where it is right now, but
Yeah.
it's really high interest debt for people. So the idea that they can consolidate that debt into a personal loan will continue to resonate with people as interest rates come down. It makes sense, like if you can refinance and a 20% debt for like a 10 or 12% debt, then it makes like total sense. And I think people will continue to do it.
So let's pivot this a little bit because the time's flying so fast already. Um, we're talking about the strength of the customer base and everything. Financial services.
Mhm,
How do you see the SoFi Money product doing? How do you foresee these types of products that are
mhm,
benefiting from high interest rates doing as rates start to get cut? As you said, SoFi
mhm.
might be holding up those rates longer than their competitors.
Yeah, so I think SoFi Money, like I'm a user of SoFi Money, right? So I bank
It's
with
their
SoFi
checking and
now.
savings account product for the
Mhm.
people that don't know, by the way. Sorry.
Yes. So it's checking and savings. So SoFi Money is all about checking and savings accounts that people can have and get paid a good interest rate,
Mhm.
which is right now at 4.6% APY. So I moved over my money from JP Morgan, Chase a while back. Like it's been a couple of years now. I've been using SoFi for a while. And the thing is like even when they weren't paying 4.6%, I still chose to bank with SoFi, just because it was that all-in-one platform wherein I can do
Right.
my investing, I can take care of all the, like, paying to my friends or something, so it more or less solves all my problems in one place. And I'm not going, like, I'm not planning to move my money back to say a JP Morgan if I get like like the rates go down back to zero. I still don't see a reason why I should move over my money.
Yeah,
So
because SoFi will still probably be offering you 1% or something versus,
yes,
what JP
very,
Morgan is
very
still going to be
likely,
offering you at 0.
yes.
Right, right. So yeah, I mean, I'm excited about the member growth there, and their SoFi Money product has just been holding up some of their. Uh, they talk about fixed costs a lot on their investing credit card products a lot, and I'm not saying that they're misguiding people, but their credit card losses are
Mhm,
so unbelievably high. I think it was 18% last quarter. I
mhm,
probably don't suspect it's going to change too much. They almost didn't bring on. I think it was like only 9,000 new credit cards this quarter. So I
mhm.
definitely think they're trying to slow that product down. How long until we start seeing contribution profitability from all product lines? Do you have any assumptions on that, by the way, for financial services to really take over?
The overall the segment became contribution profit margin positive.
Right.
So as long as I think they are able to drive more growth, the management is unlikely to stop investing in these products.
Yeah.
And I think more new products are going to come out. Like the assumption that they'll slow down anytime soon is probably a little misguided, because um, it is their growth engine. So
Right.
like in terms of how they are looking at this business, they don't actually want lending to be their main business. They
Sure.
want financial services and technology platform to be the growth drivers and to become their profit centers in the long run.
Right.
So stopping right now wouldn't make any sense. I think that credit card business is probably not doing as well as they might have hoped. But of course, you're building out a new book of business, and it is going to take
Yeah.
some time for that book to mature. And then, you can expand it. I think on the call, they said that they are looking to expand the credit card business even further. And I believe that they will they will create a big business out of those credit cards, debit cards, and probably I think more so, connecting, like having all products that a customer needs in their financial journey is very important. Even if credit cards are a loss leader right now, they are an important piece to help the members, like those
Right.
7.5 million members, use SoFi across their financial journey. Like they over the long run, I think a customer may not have to think beyond SoFi when they want to think about their financial products.
So I guess the reason why I'm so fixated on each individual product, and credit cards potentially could be great uh, loss leader, but it's not necessarily the case for most financial
Mhm.
institutions. That's why I think I'm so fixated on that product for so long. But um, as as interest rates start to fall, and SoFi
Mhm.
wants to be that company that can hold rates higher than others, do you
Mhm.
think that contribution profitability will go down over time for that segment?
No, I think it's turned positive, and from here it'll keep rising.
Okay.
Um, so some of their products have matured, like SoFi Money has matured. It's like a cash cow now. Similarly, as these products mature, like more of these products mature, they will not let it sink back into the negative.
Sure.
And I think once some more of these products mature, only after that would they introduce newer products. Like they talked about bringing small business checking and savings account. They brought up another idea, like small business lending. So they are not going to add all these products to their organization until and unless they know that the
There's
existing
some
businesses are
maturity.
already profitable,
Yeah.
right? So they
Yeah.
are going to keep, like, I love this management because they are not trying to push things too fast. They saw, like, I think it is one of the few companies that have guided for 2024 so conservatively. Like very,
Yeah.
very few companies have done that. um so yeah, I think they understand their business very well. They know that they want to run it profitably. If you look at their outlook for 2026, that's like 80 cents. profit. I think they
Mhm.
can easily beat it. They'll probably beat it because they have a history of sandbagging things. So if they are doing like $1 in earnings, you're buying SoFi at like 7-8 times 2026 earnings right now,
Right,
which
right.
is very cheap because they plan to grow our EPS or earnings at 20 to 25% beyond that.
Yeah,
So
yeah. Even yeah, every year beyond. Exactly. So I have a question, by the way.
mhm,
Whenever looking at um, each segment, they want to get into new products, like you said, for
mhm,
2026. Is this baked into your fair value assumption of being around, I think you said
mhm.
$21 a share? Where is it?
Yes. So
1677 to 2086 per share?
mhm. So no, it's not baked in. I haven't baked in any other business lines.
Okay.
How I have modeled is on the basis of existing offerings and how I see those offerings grow.
Right.
So yeah, I haven't factored in any new businesses that SoFi will build over the next 3 years, 2 years.
And then I just want to hear, just speculatively, just your
Mhm,
own opinion. They are assuming 2.3 million new members in
mhm,
2024. The way that SoFi Money, SoFi Relay, all of
mhm.
these amazing products have grown the user base like crazy. Are you taking the over or under on that $2.3 million bet, or
So
2.3 million member bet? Sorry.
I was at 10 million. Like my model accounts for 10 million, and it is like the guidance is slightly under that. Like it's around 9.8 million. But I don't know. I mean, they are generally conservative, so hopefully it'll be over 10 million, well above 10 million. But I have modeled for 10 million users, and this model was like done in like almost in 2022. So at
Right.
the start of 2023. So I was at around 10 million mark. They are guiding very close to that. I hope that they are able to push more growth. And I think when network effects come into play, which they are with SoFi, I believe that they will be able to push more growth, especially if rates are cut. And then, some of the digital banks will probably stop, chasing customers by
Right.
offering higher and higher rates. If SoFi is able to sustain or offer those higher rates for a little longer, I think they'll be able to push more member growth.
So I want to talk about technology platform, but I'm going to push
Mhm,
that off for just 1 second as I ask a question about their conservative guidance.
mhm,
So SoFi has always done. You even wrote it the exact same way as I like to say it. They do the beat and raise strategy quarter
mhm.
after quarter after quarter. Do you think that this could potentially harm the valuation for the stock as people are not baking in uh, potentially better than expected results going forward? Like a new investor that's coming to look at
Mhm.
SoFi, do you think that their 2024 guidance is deterring them from investing in the company because they might only be baking in like under
Mhm.
20% top line growth?
Yes, I mean, as I said, the implied growth for that guidance is around 15 to 23%,
Right.
um, which is like calling for a big deceleration from like almost 34% growth which we
Right.
saw in Q4. Customers, or I mean investors, would surely look at this and say, okay, why would we pay a premium for a young bank? That's probably slowing down in growth when, let's say, a JP Morgan is able to grow at 10%. So do I really need to take the risk and go with SoFi? So I think that question mark remains over the head of like in central to investors who are running this process. If you look at a price to book analysis for these businesses, SoFi is trading at the top end of other, like compared to other
Yeah.
banks.
Yeah.
It is not trading at a premium, but it has a valuations very similar to JP Morgan,
Hmm.
right? So the market currently is not assigning any growth premium to SoFi, which is where I believe the opportunity is. It will grow. The business is growing. The momentum is there. How to identify this business momentum? I think the place where people need to look is the member growth and how many members are spending more on the platform or using the platform more.
Right.
So that is growing. That is visible in the numbers. So for next year, let's say SoFi is saying we'll grow at 15 to 23% because we are slowing down our lending, but our member growth will be 30%.
Right.
So that underlying trend or that underlying ecosystem is growing rapidly, although the revenue it generates is slowing down. So it's like if investors look in the right place, they know that this business or this ecosystem is growing much faster than what revenue we are seeing. So eventually that revenues will catch up, and they will at some point, monetize at the same level. That platform will monetize at the same level.
Another thing that you touched on there, the first time, I think it was Q4 of 2022,
Mhm,
did their guidance for 2023 for full
mhm,
year. I think they said about $200 million in adjusted EBITDA. I think it was
mhm,
a range from 200 to 230.
mhm.
Finishing the year now, we know that it came in at, I think, $432 million of adjusted EBITDA.
Right.
This year, full year, they're saying it's going to be, I think, 580 to
Mhm,
590 million. Where do you see top line growth, just personally, your
mhm,
own opinion, coming in for top line growth and EBITDA and then
mhm,
GAAP net income? How do you think that actually factors versus their assumptions?
mhm. Yes. So as I said earlier at the beginning of this video, that for now we are also looking at a slowdown, an economic slowdown. So I'm not sure where SoFi's growth will land. I do believe that what they have priced in is probably too extreme in terms of minus 2.5% GDP. That
Right.
that probably is too extreme. Um, we see some sort of slowdown, but not something crazy. So where I see it is like probably around 25 to 30% is where the top line growth should land, and profitability will be better than what SoFi has guided, purely because lending business is going to do the same, like around 60-65% contribution margins. And financial services, I see contribution margins going up because like where the trend is in terms of incremental EBITDA margin, the more they grow, the better it becomes.
Yeah. Yeah.
So yeah, I mean, they said we'll exit at 30% EBITDA margin. I think they can do 30% EBITDA margin for the entire year.
Right.
Uh, which is where Q4 numbers were. So I believe that
And
they will have a good year.
they said they could do better than that, right? Because they still are paying off a lot of their fixed costs. However, there's probably more
I
fixed costs to
mean,
come
I
as
mean,
they
what
build
they
out.
said was right now the EBITDA margins will go down
Okay.
because they will do less lending, and then by the end of the year we'll be back at 30% EBITDA margin.
Sure. Sure. For
So,
full year, you mean?
and long term they can do even higher. So that's what they said. Now it's very simple to believe this argument that they can do better because they are not a traditional bank. So they don't have a lot of fixed costs. They don't have those physical branches to manage. They have low human capital cost. So it is like I
No
understand
shareholder
they
payouts
yeah,
to deal in.
yeah. I mean, no shareholder payouts to do. So they are going to have probably the highest margins in the industry, which is also why I believe that SoFi being priced like a traditional bank is wrong, because
Hmm.
they are going to have the best unit economics out there. And if they have a high growth rate, you can't assign the same sort of multiple as a traditional bank commands.
Now, let me ask you though: do you think that a lot of those rates that
Mhm,
potentially SoFi is saving on their expenses for being fully digital, for
mhm,
not having a high payout ratio for dividends or anything along those lines, that they are spending those on better member benefits like the 4.6% that you
mhm,
might not be seeing at the traditional JP Morgans or the Big Four or anything like that? Like potentially they could still have very similar margins. They're just paying it
mhm.
out to their consumers rather than their shareholders.
Yes, I mean, in some way of like some form they are doing it for their members. They are servicing their members better. But if you think about it, like if you think about SoFi money, right? So if they are giving you 4.6%, whereas just not like they can just go and park that money in treasuries and make 5%.
Right.
So it's not like they are giving you something from their profit margins. They are giving you something for providing that cost of capital, like lowering their cost of capital. So it's a win-win for customers and SoFi. And I don't think that they are giving something out of pocket. Yes, they can boost their margins even more if they were to get a little less customer friendly, say, okay, we won't give you 4.6% APY, we'll give you 1%. So that could be a thing, but I don't think SoFi is thinking small. I think they're thinking big. If you hear the management talk about becoming the 10th largest financial, like a top 10 financial institution in the world. So how do they get there? I think they get there by being customer friendly, by focusing on their members. And the only way they can do it is like, spend on their customers, make them happy, delight them. And that's how they
Yeah.
grow.
Yeah. I would just like to say with the with how you said that, you know, they could just park it in treasuries and that they're not
Mhm.
actually running it in negatives. But couldn't the same thing be said with JP Morgan, that they could just park it
Yeah,
in treasuries, but they're
mhm.
going
Yeah,
from
they are doing it.
point 1 to 5, you know?
Mhm. Yeah, but they are doing it, and
Yeah,
why are they not able to give their customers say a 4% APY or a 3% APY? They can't do it because they are stuck with all those physical branches. They are stuck
right.
with all those costs, and
Yeah,
that's a downside for those businesses. Like if you look at JP Morgan Chase, right? So they also have a mobile app. It's not like they don't have that digital presence. The problem is they are stuck with those branches. They can't get rid of them. Those
yeah.
expenses, they are there for them forever.
My belief is, and I don't know if this will actually hold true, but my feeling is that JP Morgan and the big four that are Bank of America being very forward on this as well, getting their members onto their mobile platforms and trying to
Mhm.
stay very modern is almost just teaching the audience how to use these platforms
Mhm.
to then go and switch to SoFi eventually because of the just the better rates and the better services. Um,
Yes, but
yeah,
I mean they have to push. Like they have to do it. Otherwise, they'll lose their customer base very quickly.
right, right. Um, let's move on to the tech platform. So
Mhm.
this is a combination of both two main companies that SoFi had acquired. The
Mhm.
Galileo, $1.2 billion acquisition for a tiny
Mhm.
little company like SoFi, and then another $1.1 billion acquisition for Technisys.
Mhm.
Combined, these companies saw a 13% year over year growth from
Mhm.
2022 to 2023. Slower than expected, but a hard macro
Mhm.
environment. They're saying for 2024, now that a lot of these costs from going from like on prem onto fully on the cloud
Mhm.
have kind of been paid for, now they're trying to reach for 20% growth rates. How do you see the tech platform sort of
Mhm.
factoring into SoFi's valuation, and where do you see that growth going forward?
Yeah, so I think this segment is has probably been the weakest link in the SoFi story
Sure.
for the last couple of years. Um, they I think when they bought Galileo and like then purchased Technisys to build their presence in LATAM, it was more or less like SoFi doesn't just want to be a bank, uh, it wants to be a technology provider for banks, right? So this banking as a service platform that they have built over I think a year, like the last year or so, completely focusing on the cloud. And this platform, I think they are focusing now on bigger institutions, which is
Right.
something that they have said. I think it makes a lot of sense. Earlier they had a lot of small banks, small customers, and they were fighting for those deals, and then those deals would drop off. So it wasn't a great business. Now that they are getting some bigger customers, and I think the pipeline is very strong according to what the management has said. um, I believe that technology platform will eventually become a big portion of the business, but I don't think that it is there right now, like in terms of adoption. SoFi does need to prove by getting probably a big fish to adopt its platform,
Yeah.
just to showcase to the world that hey, we have the technology that you need for all your BaaS requirements, and you can just shift to us and give us all that infrastructure to manage, and we'll do it for you, right?
Right.
This will be a tough challenge because SoFi itself is a bank. To convince other financial institutions to give their infrastructure in your hands, it's going to be tough. I'm sure that they are working on, creating walls within the company to ensure that the technology platform has the freedom to grow. Um, so yeah, I mean that's where my head is in terms of where the technology business is right now. I do hope to see more progress there. A growth acceleration there would convince me to assign SoFi a higher exit multiple, wherein I can see that okay, technology platform is there, it's growing, and it's probably gonna change market's perception for SoFi from being purely a digital bank, which there are loads and loads of, to a technology service provider, which there are very few.
Do you think that that growth will accelerate past 20% from the top end? And where do you see their contribution margin for the tech platform going forward?
Mhm. So I think contribution margin for the technology platform will probably stay where it is right now.
Sure.
It's around 32%. I think it won't move up from here for a while, as management tries to get more customers on board. and grow more aggressively. In terms of growth, I think, or I hope that they can accelerate beyond 20%, but I'd be more than satisfied if they can hit 20%.
Sure. Okay. And even so, one of the things that I really liked from your article as well, and I'll just read this. You said that your investment thesis for SoFi is the ability to facilitate cross buying from a broad range of financial services through the single digital substrate.
Mhm.
What part of that is baked into the importance of Technisys bringing it all onto one multi-product core? Do you think that they need potentially more acquisitions to get better technology, because they don't seem to want to deal with third parties anymore? They just keep acquiring every company they need.
Yes.
Where do you see that sort of playing out in their one-stop shop
Mhm.
idea?
Yeah, I think the vision is to build a technology platform that can serve like all financial needs for all customers, whether those customers are coming to financial institutions or non-financial institutions.
Right.
So SoFi is not just solving for other banks; it's also trying to solve those problems for other non-financial institutions. So let's say an Airbnb wants to start offering some sort of checkings or savings accounts,
Yeah.
right? And they want
Some
to
air
build,
card or something.
yeah, an ad card or a loyalty program around it. So they SoFi at the end of the day wants to manage all of this infrastructure, and for that you need to have a clean stack, a clean technology stack, which they have built and they are building through acquisitions. I'm not sure how many more acquisitions they will need to do, but I mean they have the financial resources to go and do it. So if something comes up wherein the opportunity is good, I think Anthony Noto and his team will execute. Um, but yeah.
uh, I also wanted to ask, so with just going back to the macro,
Mhm,
you said that you saw similar assumptions to what SoFi had said. However, they might even be more conservative
mhm,
on their GDP assumptions and stuff like this. But do you think that SoFi, if the macro is exactly how they say it is, could still see uh, better than presumed growth assumptions, let alone if macro
mhm,
doesn't switch? Because it's my belief, and I'm sure it's yours, that if the macro does switch, then they're going to see better numbers than assumed. But
mhm.
if they get exactly what it is projected, do you think lending will be in their area of growth of
Mhm.
92 to 95% of last year?
Well, it could be. So the constraint is not coming from the capacities point of view.
Right.
So they have the money. If they want to lend it out, they can. But it'll be the management's decision if they want to do it or not. So if the economy is heading exactly as they thought it was, they may not want to be more aggressive in their lending business. So I believe that, and if they see something worse than what they have modeled for, they might be even more conservative. So I understand that this guidance is probably on the conservative side from them. They don't want to give a negative shock to people in terms of like minus, like from 92 to 95% growth. So that is like calling for a 5 to 8% decline in the lending revenues. If you
Right.
if you like look at the business, the originations will be down even more because your NII is going to shoot up next year as well, considering all the lending that they did this year, which was growing from
Right.
last year, right? So the originations, they are probably looking at like minus 20-25% decline in originations. So it's a real slowdown from them in terms of how much they want to lend, right? So
Yeah.
I believe it is probably too conservative. Um, and we'll see like how the year goes, but we'll find out in a couple of quarters.
So did you see two things? So one, in the earnings call, they said that they wanted to keep capital ratios above 14%
Mhm,
in 2024. I thought that that was a low statement to make, considering we're already above 15% and you're
mhm,
looking to slow even further. Um, it almost sounds like they are considering not accelerating lending, but
mhm.
maintaining their originations year over year. I think they're kind of, that's just a personal opinion, but yeah.
Yeah, I think what they are looking at is probably a spike in defaults because they operate in a risky, unsecured lending
Right.
space, right? So if they are thinking that okay, there will be a minus 2.5% GDP and unemployment rate will spike above 5%, then they might be factoring in higher default rates. which is probably why they are saying, okay, maybe we won't lend out as much. We want to preserve our capital
Sure.
ratios. And I think they said that we are going to increase our tangible book value by 300 to 500 million this year.
Mhm.
They'll probably do have greater than that. So if they are able to do that, then those capital ratios would not be a problem. But I don't think they are running their bank like a traditional bank wherein you are operating very close to those capital ratios. They want to maintain a good margin of safety. I think that's how they are managing the business, and I think that's a fair thing to do.
Yeah, yeah, fair. And then I don't know if you saw someone was sharing on X recently that their First Republic student
Mhm.
loans had actually gotten purchased by SoFi. Did you see
Mhm.
this?
I haven't
What do you,
seen. I haven't
okay, well,
seen
what
this
what do
one.
you think about the idea of them actually going out and acquiring potentially either it's the servicing rights or the actual full loan rights to potentially buying loans right now? Like that's the exciting thing for me, at least
Mhm.
for SoFi, is they have so many levers that
Mhm.
growth doesn't necessarily just have to come from new members getting personal loans. They have so many different
Mhm.
ways of growing the business. Did you factor any of this in whenever looking at your fair value assumptions that SoFi could potentially still grow even if it's not from their own originations?
So I generally model on the basis of existing business. I
Sure,
don't like, and I would base my model on top line, overall top line, instead of looking at like granular each business and then how can they grow this particular thing. um, so I haven't factored in like per se that can they go out and buy some loans from the market. I haven't done that, but I believe that they can. It's a lever they can pull if there's a good deal out there. Let's say some other institution, like as you mentioned, like First Republic, but maybe there could be another institution that's selling their loans at a big loss, and these people can pick it up
sure,
and make money on it. So I mean, it's smart allocation of capital. They can definitely do it as long as they have ample capital to allocate, and if they fail to find good borrowers within their ecosystem. So right now, SoFi has 7.5 million members. I think that is enough to support um, their own capacity. And of course, there are new lenders coming into their ecosystem, which is like new members, new customers. But if they cannot find new customers to take loans out from them, they can go out and buy loans from other companies, which are probably going to be profitable thing to do.
so I guess whenever I said that, whether you baked it into your models, I didn't necessarily mean every single segment and the
Mhm.
little factors. I meant more along the lines of a surprise on the high side or low side. That sort of
Mhm.
range that SoFi could hit
Mhm.
might be potentially larger than people are considering for other businesses because
Mhm.
of that bank charter, right? So um, I don't know if I have any other questions uh, regarding SoFi. I mean, I guess one would be here for your fair value assumption,
Mhm.
or even your own portfolio. What's the hold time? What's the time horizon for your investment, and where do you see this company
Mhm.
midterm or long term?
Yeah, so for me, SoFi is at least a 3 to 5 year plus investment.
Okay,
So I would put it in the long term bucket. Um, why do you need more time, like or spend more time with this company? I think it's a very special bank or very special financial institution that's very early right now, and how it is growing with its customer base. Its customer base came from student loans, which was high earning individuals. And as this customer segment is in my view, this is a very special customer segment. As this customer segment matures, they will do more spending, like in terms of buying a house, buying a car. And as this particular group of or cohort of customers grows with SoFi, they bank on SoFi, they rely on SoFi. I think it gets bigger and bigger. Those network effects kick in, and this could become like probably one of the largest financial institutions on earth. They'll probably have unit economics better than any other financial institution out there. So better than any other bank. They will probably be able to grow um, for years and years and years. Like this is probably in a very nascent stage. consider this: they have 7.5 million members. The US population is 330 million,
Yeah.
and you're just getting started. Like, this is just the US, right? You have to consider Latin America, you have to consider Europe, and they
Right.
they will expand, right? So this is just the beginning. We are very, very early. I know the market has pressurized SoFi to become profitable, but they have delivered on that as well. And from here on out, it's a profitable growth story. So like, the bigger it grows, the more profitable the company becomes. And it's just like, as I said, like, the profit party is just getting started with SoFi.
I think that's the only way to wrap up this conversation. Ahan, thank you so much. I really do appreciate you coming on the show. Ladies and gentlemen, if you guys want to check him out, that's his Twitter handle right over there, TQ Investor, as well as being on Seeking Alpha. So go check him out on both those links, and I'll even put them in the description down below. But thank you so much for coming on the show.
Yeah, thank you so much for having me, Tanner.